Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I like to interview him every couple months about the gold market, gold miners, also macro. He also started a Bitcoin fund, the Bitcoin Opportunity Fund. He's one of the co-founders, I believe. Gold fund manager at Equity Management Associates, Lawrence Lepard. Thank you for joining me again.
Hey, great to be with you, Jason. I always enjoy our conversations because you're so tuned into what's going on in Washington, D.C.
Yes, I mean, the stuff I hear just at some of the barbecues on Labor Day or out drinking sometimes and running into government employees at the FDIC or bank lobbyists. I've had dinner with, I think, quite a few FDIC employees over the years, over the last 10 or so years, just hearing these are lower level or mid managers just complaining about all the stuff the banksters get away with.
Yeah, it's pretty bad, isn't it?
Well,
So where do you want to go today? Yeah.
So we're recording this interview on Thursday, October 26, 2023. For our listeners out there, the GDP report, let's start with this. So a 4.9% GDP report. I mean, the US is growing like crazy, Lawrence. That's an impressive GDP report.
Well, no, the US reported a 4.9% GDP growth. The fact of the matter is that all of the US numbers are, an illusion, and that, we now know enough about how all this works that we know that they're lying to us. And I'll tell you how I think this lie gets told. I'd love to see the GDP in terms of units sold, because GDP is supposed to reflect things produced and things sold. And, we've got a 4.9% growth, and that's supposed to be net of inflation. So, and we know that the inflation numbers they're using are somewhere in the threes. So that means that it actually was nominal 7% growth. Take away the inflation, there's actually 4.9% growth. But what you just heard me say is they're saying inflation is in the threes. I don't think it is. I think it's substantially higher than that, and they're misreporting it. Shadow Government Stats has talked about that for years. And so, in my sense, inflation was probably 7, 8, 9, and the growth was probably 7, 8, 9. So, in fact, GDP was flat on an inflation-adjusted basis. It just looks like it went up because prices went up, and not all of that price increase got stripped out. I mean, I'd be willing to bet that, I don't have my Bloomberg in front of me, but I'd be willing to bet that auto sales were flat, year over year, quarter over quarter. I know for a fact, as you just talked about pre-show, home sales in the DC area and other areas, home sales are down substantially because of the high interest rates on mortgages. So I think the numbers are cooked. And I think that, they're not right. I mean, it's similar to a way, while we're on the topic, that I think the employment numbers are cooked. I mean, we show very, very low unemployment, but as you know, they were, they have, some adjustments that they make, that jobs they think got created, that they don't really know. They have a bunch of plug factors. And then on top of that, they've managed to, over the years, create this bucket that's called discouraged workers who are not in the labor force. And that bucket has gotten really big. And so I think if you put them back in there, we'd find out that there's quite high unemployment. But of course, that's not what they want to show. And so the numbers don't reflect that.
Yeah, I agree with your assessment there of GDP and the jobs report. For my listeners out there, I was just being sarcastic about the US's growth at 4.9%. They're using tons of deflators here they're not even using the real CPI number, right? Because if the government says it's growing at 4.9 and the CPI is above 3%, actually, I think some of the inflation numbers, weren't they a week or two ago? They ran hot, at least part of it. I don't know if it was the CPI. Wasn't it the producer price index and the other inflation ones?
But recall, as I understand it, could be wrong about this, as I understand it, they report the GDP number. It's supposed to be inflation adjusted. It's supposed to be net.
But the base effects at some point, I mean, I've listened to Fox Business and seen some other PhD economists talking about this. They're talking about how the base effects are eventually going to catch up and knock the CPI down to 2% or less soon in the next 6 months. Yeah. I guess I'll take out Paul Krugman was tweeting about how if we don't eat or don't use utilities or don't use healthcare or don't use gasoline or don't use diesel or don't use electricity, there is no inflation.
Exactly. Yeah. Yeah. I mean, it's and that, to me, what Krugman's doing is he's trying to help their narrative, because we know they're going to be forced into pivoting. And, they want to try and contend that they've got inflation tamed before they do that, before they're forced to do that. And so, he says it's under control. And you see a lot of the Fed heads coming out saying, well, it looks like the conditions have gotten very tight and we may not need to continue tightening, et cetera, et cetera. And that's because things are starting to break, and you can see them breaking when you look at the the rate, the interest yield on the 10-year, which has gone up substantially in the last 3 months, and is reflecting the fact that we're having a hard time finding buyers for our bonds. The 10 and 30-year auctions, the tails on those have been very, very weak, and so as a result, they're going to need to at some point here pivot. Stop raising rates. I mean, we know they're not going to raise them next week. And I think ultimately they're going to be forced into cutting rates and resuming QE, but that's all a little ways down the road. They're still trying to hang on to their inflation's under control narrative, and I don't think it is. I think they're wrong, but they're going to try and use that as a justification for why they're okay to pivot.
Well, we're seeing a lot of red flags. So it's not just the 10-year US Treasury yield. I mean, the yield curve, it was inverted for over 220 days. It just uninverted. And normally that's a perfect indicator that the recession is soon. So that's one of the red flags. The VIX is starting to spike again. That's another. The dollar index is at 106.6. All these things adding up. And then you had what in the last couple of weeks, you had a big oil spike and a big gold spike. So all these things adding up together just are red flag, red flag, red flag. And then we get this nice GDP number, but we've had nice jobs reports for the last couple of months, but it always seems a month or two later, they're always revised downwards by 50%.
Exactly. That just goes to how cooked all the numbers are. And I think the big elephant in the room, as you and I discussed earlier, is the fact that even with this so-called healthy economy, we're still managing to run $2 trillion annual deficits and growing because the interest rate on the average interest rate on the debt, as I talk about in my Q2 letter, is still only 2.5%. When across the curve for the treasuries, the rates are 5%. And so as we slowly but surely work through all the maturing debt, it's going to get termed out, it's going to get sold off, and we're going to have higher rates. And so, the US federal government, and one of the scariest charts in macro, in my opinion, is the chart of US federal interest expense. I mean, it's literally just going parabolic. We're now at $980 billion in annual interest expense, more than we spend on defense. And that's with rates at 2.5% on average on that debt. And that'll go higher. And so, in my view, what we're really in here is kind of a debt doom loop, a federal government debt doom loop. And I don't see any will on the part of anyone in Washington to really get this under control.
Yeah, I agree. This is finally the math problem that people, and I read the first Market Wizards book. I don't know if you read that one.
I did. It's a great book. Yeah.
So Jim Rogers is actually in there. And I think that book came out in the late 80s or early 90s, because that's very similar. He was interviewing famous investors and traders and hedge fund guys. It's very similar to what's the podcast now and the YouTube channels. He was way ahead of his time. Jim Rogers was talking about the debt problems back then, but there was no issues like right now about the total size of national debt and the interest payments on the national debt. They were not a problem 20, 30 years ago. Now here we are. If they roll over the debt at a much higher interest rate in the next 6, 12, 18 months, could be looking at 30, 40% of the annual tax receipts just on interest payments.
Correct. I mean, it's funny how quaint the old numbers are. I started in the business in the 80s, and I recall very clearly the first deficit spender really was Ronald Reagan. He used deficit spending trickle down to try and get out of the recession that we were in. And in 83, I think the federal deficit was $50 billion. And everyone was just howling at how outrageous that was and how large that was and everything else. And, that's just a day's worth of commitments on Biden's part. I mean, we saw recently he talked about 50 billion domestically and 100 billion for a combination of Ukraine and Israel. I mean, these guys are throwing around, 50, 100, more billions, like they're just pocket change. And as Everett Dirksen said, a billion here, a billion there, pretty soon you're talking real money.
Well, now we're at $1 trillion. Yeah. I mean, we're at like almost $1 trillion now. So like even tens of billions or hundreds of billions, it's a small number compared to, so like when I first started 15 years ago, tens of billions or 100 billion was a large number. Then all the bank bailouts started coming in. It was for trillions of dollars. The stimulus packages were for hundreds of billions or a trillion. Oh. So it seems like over the last 10 or 15 years, we've just gone an order of magnitude larger for everything.
Right. And sadly, I think that's only going to continue. I mean, I think they grew the balance sheet on the COVID blow up. They grew the balance sheet to just under 9 trillion, and now it's shrunk back a little bit. And that was up from the 3.7 that they grew it on the bursting of the housing bubble. And, I think the next time they have to print, it'll probably be $20 trillion. And if you look at no doubt you've seen the federal debt growth run rate. I mean, Now, I don't think this can continue. I think they had a lot that was backed up because of the way they were, they had a debt ceiling and everything else. But, the run rate on the federal debt, I mean, we would add I think it was, in a month or two, we'd added $600 billion. I mean, it's outrageous. I mean, we're at 33.6 billion or trillion of debt right now. And, we'll be at 40 trillion before you blink an eye.
Well, the other part of this is the real economy. So I think the real economy is bifurcated. So we're already seeing U.S. federal government tax receipts start to fall a lot, but now we're starting to see the banks are firing like crazy. So like Goldman Sachs and many of the other banks are firing thousands of employees. And at these interest rates, also a lot of those Silicon Valley unicorns that are not viable businesses that never focused on profits and just revenue growth only, they can't raise capital. So that's going to be a lot of jobs lost. But guess which entity created the most jobs in the jobs reports the last 12 months, Lawrence?
I don't know. Is it government?
Yep, exactly.
Yeah.
So
Yeah.
Almost all of the mainstream financial media leaves that part out, that the largest industry that was creating the most jobs are federal government jobs.
Doesn't surprise me, that and the military industrial complex. I mean, I retweeted a gross video of Mitch McConnell talking about how great it was that we were supplying all these arms to the world, and that when we gave aid to Ukraine, the money actually stayed here because it went to our arms manufacturers to make weapons to go kill people, and that's a good thing. It was disgusting, but
well, it's good for profits and high salaries here and stock options and insider trading here in the Washington, D.C. metro area, because that's as long as the government spending goes up any way possible, whether it's the Green New Deal or a new war or a new subsidy to a new government or something like that. I mean, that's beneficial to the Cantillon effect in the D.C. metro area.
I would imagine. I know it's one of the wealthiest areas in the country, and it's not surprising. I mean, you're very close to all the money that comes out and gets spent.
It is, I would argue, it is the wealthiest area in the whole country because it has 5 out of the 10 highest average median family income counties in the whole country. 5 of the 10 are right outside of Washington.
I wasn't
DC.
aware of that, but that doesn't surprise me. Yeah.
Well, unfortunately, I see more welfare, more warfare, more government spending. I mean, I don't really see anything that could cut them back, even with the problems in the Treasury market.
Yeah, well, eventually they're all going to get cut back severely because the currency will fail. But that's a 10-year project. That's not going to happen tomorrow. But it's Stein's law, right? If something cannot continue forever, it will end. You just can't keep spending more than you bring in and printing the difference without eventually having a loss of confidence in the currency. And that's coming. We know that's coming. It's mathematically baked in the cake, unless, and this is unlikely, but not impossible, they get seriously fiscally responsible and, raise taxes and cut expenses and try and balance the budget.
But that'll crash the economy, and then people either won't have jobs or companies will fire, and then people won't be able to pay the taxes. So I just see
it's exactly. And what you've described is that they're really trapped. It's really kind of checkmate for the monetary authorities and for the government, sadly. And that's going to create a lot of pain. And it's going to be one hell of an awful transition. But what I cheer myself up with is that we got a lot of great people in this country, and eventually we'll get through it, and hopefully we'll return to a sound money standard. And when we do, things will be substantially better than they are now. So, but that's
until we get to that point, though, and more people wake up. I think it's more stagflate tax lie as a best case scenario, and then more extend and pretend rules changes, goalpost moving, hidden bailouts, covert bailouts, shadow liquidity programs. We were discussing before we started recording the crazy stuff that I'm hearing from bankers off the record here in the United States about all the extend and pretend for commercial real estate that the banks are getting away with here in major metro areas and cities in Texas. And it's very similar to 2005, 2006, and 2007 for residential real estate.
I think that's right. And, we know that the people in charge of the system will do everything they can to break the rules and change the system. I mean, let's just take a concrete recent example. The Silicon Valley Bank failed, right? Their balance sheet was upside down. They were suckered into buying, or they stupidly bought very low interest, long duration debt, which when the Fed raised rates, went quickly underwater. And, what should have happened there is that we should have followed the Dodd-Frank law, which post 2008 said, "Thou shalt not bail out the banks." If a bank fails, the depositors will have to take a hit. Well, it turns out that that's not quite what happened. And the reason it's not quite what happened is because the depositors were very well known, high profile people, actresses, actors, VC people, Californians, etc.
The richest people. Yeah, the richest people in California.
Right. And people like Bill Ackman, and they all started crying like babies and said, we can't take a hit. We're going to have a bank crisis. The entire banking system is going to fail. And so what did the Fed do? It broke the law. It just changed the law and said, oh, okay, no problem. We'll give you these swap lines. We'll call it BTFP, Bank Term Funding Proposal. It'll only be a year. It's not printing money because we're giving you $1 for 70 cents, but it's not printing money because it's a loan and you got to pay it back in a year. Of course, it'll be extended and rolled because they won't be able to pay it back. Well, and it really is printing money. And so these are the kinds of things that we've observed them doing, for 20 odd years. I mean, this is not the first time they've changed the rules to protect themselves. And we know they will continue to do it. Now, that's the bad news. What's the good news? Because of that, we know the outcome, which will always be they will print more money. They will debase the currency. And guess what? We've got things that address that. We've got solutions to currency debasement. They're very simple: gold, silver, Bitcoin, and oil and real estate to an extent, even stocks to an extent. But
uranium too. I mean, all different types of commodities are the best inflation hedge over longer cycles.
Exactly. And so we know where to go. We know what they're going to do, and we know where to go. But
the average person maybe hasn't followed all the details for Silicon Valley Bank. It's crazy, like you said. I mean, I saw Sharon Stone, that famous actress who won Oscars. She said she had half of her savings invested at that bank. So I'm sure she was making phone calls and emails furiously to her local senator or congressman or bank. Maybe she even knows some bank lobbyists to get the laws changed. And of course, the Fed set up the shadow liquidity. Like you said, though, the laws were in place. I mean, since 2015 or so, there was a ton of financial YouTubers billing. And I was like, anytime one of these banks, and Silicon Valley Bank wasn't even that large, but they had like a bunch of their customers were super rich and well-known people that were politically connected. So anytime one of these banks that's large enough or has the right political connection gets in trouble, they're just going to do covert bailouts or change the rules. They did the same for listeners who are new to this. They did the same thing in the 2019 repo crisis. Like what you said, they were loaning at par to a bunch of toxic garbage. And then they said like, oh, it's all these temporary repo facilities. It's all expiring in, I think at first was a week, and then it was a couple months, and then it was.
Yeah, I think somebody discovered they let out like $17 trillion in that episode. And I mean, that's why, and this goes to the corruption of the whole matter. And some people probably don't know this. Ben Bernanke, former Fed chairman, is an advisor to Citadel. Ken Griffin, one of the, a billionaire who's made his money by playing this risk parity trade. And, what I've heard is that they were basically bankrupt when that blowout occurred. And yet, Bernanke, I mean, who's rumored to be paid $20 million a year as an advisor, was able to go to Powell and say, you got to give this guy a swap line or he's going to blow up and it's going to destroy the markets. And this is the way that the elites and the people who are at the top of the system, game the system, have the power and the ability to game the system. And, they benefit at the expense of everybody else. Another perfect example of this, and he used to be on Twitter, but I think we shamed him into not tweeting anymore, is Lloyd Blankfein, who was at Goldman Sachs in 2008 when Goldman blew up. And, Goldman should have been bankrupt. Lloyd Blankfein should have been bankrupt. Instead, he's a billionaire and has a $60 million house in the Hamptons. And that's all because the federal government bailed out Goldman Sachs, period, full stop. And this is just the way the game works. And until we can get, these people to play by the rules, sadly, what I think it's going to take a complete failure of the currency and then a demand by those of us who are all impoverished and, a country that's on its knees is going to have to go back to a sound money standard so that these games don't get played, in the new version of America, which I believe will be coming.
And John Corzine blew up MF Global. He was commingling funds. Yeah. And he has the right. For another former CEO of Goldman Sachs, top DNC political donor. He doesn't do any prison time for any of the felonies he committed either. So, I mean, there's a long list.
He took some of my money. I was actually at MF Global. I think I got about 85 cents on the dollar. I didn't get totally wiped out. They recovered a lot of it, but I should have had 100 cents on the dollar there, and I didn't get it.
How long did it take you to get the funds back, though?
And it was like 6 months to a year. Yeah, it was some
That's still
time.
better than most of those cases. I mean, like the Valley Bank stuff, there was actually it was a digital bank run. So because everyone does the online,
Yeah,
well, not everyone, but a lot of people do the online banking now. So you can literally move tens of millions of dollars
yeah. No, I
on your
remember
phone.
hearing the numbers like four. They had like 40 trillion. I think they had 100 billion, roughly 100 billion of deposits. And I remember they got like 45 billion in withdrawals in one day, and then the next day was going to be another 45 or 50, and that's when they shut it down. But I mean, yeah, a digital bank run, isn't that? I mean, it's fascinating, right? I mean, this
Well, I
is
mean, the banks like they were thinking like, oh, we'll make it easier for you to make payments online and pay your bills online. But then they didn't think, oh, what happens if we have a bank run and all the customers can pull out
yeah, right. This
40-50% of the deposits, the reserves in 24, 48
in
hours.
24 hours. Yeah, this isn't It's a Wonderful Life. I mean, you're not standing at the Bailey Savings and Loan in line. You get on your computer, click a mouse and say, "Send me my $100 million." Yeah,
Well, let me add some more color then to the 2019 repo crisis. You heard that story. I mean, I was getting messages from portfolio managers at large banks that were bond fund managers. I mean, the system blew up in the
right.
2019 repo crisis. I mean, I heard credit markets had frozen, that almost all of the over leveraged risk parity trades, and this is the trade that Ray Dalio, the top hedge fund manager for a while at Bridgewater, so they were running this trade. There was a ton of other pension funds, hedge funds, family offices, institutional investors that were running this trade. There was also the basis trade too, with different durations of treasuries, tons and tons of leverage on these bond trades. The Fed was hiking interest rates in that last cycle, and the dollar rallied too much, and that hurt all of these credit markets and bond traders outside the United States. Now, does that sound familiar? Because we have a similar situation for that last Fed rate hiking cycle with Jerome Powell to the current one.
Yeah, no, it's I'd say it's very similar.
Well, I think unfortunately, Lawrence, and I'm speaking to bankers in Canada and I'm talking with portfolio managers, it really does sound like our global financial system and banking system, especially for banks outside the United States and Eurodollar. The Fed didn't think about this. The PhD economists at the Fed, they're like, oh, okay, if there's too much inflation, we'll raise interest rates, we'll kill demand. That will help the US domestic economy fight inflation. They didn't think about what would happen to all that US Treasury bond collateral that these private foreign banks hold outside the United States when they were raising interest rates.
Yeah, no, that's correct. And one of the other things that's going to happen, in my view, is that they, as Luke Roman points out, the net international investment position, a lot of foreigners hold a lot of U.S. Treasury bills, and as their currencies continue to get pounded against the dollar, in order to defend their currency, they're going to be sellers of those Treasury bills. So this plays into what I was discussing earlier, which is the general notion that we are in a doom loop for Treasuries. I mean, one of the things, and nobody's really, in our lifetime, nobody's really seen this. I mean, there was a little bit of it in the 70s when there was a run on gold kind of at the end of the 70s, but nobody's really seen a situation where, the credit worthiness of the world's biggest, economy, or maybe not the biggest economy, but certainly the biggest monetary system, the reserve currency, the dollar, is actually being legitimately brought into question as a result of the way we're behaving. I mean, the US dollar, the US financial situation is starting to look very much like, this financial situation that's happened in emerging countries, third world countries, where, we're going to be forced to print money to pay our interest and pay our debt. And once that starts and gets really developed, then you're Turkey or you're Lebanon or you're Brazil or you're, not now, but in the past, or you're Argentina, and ultimately you could be Weimar. So the problem is a really deep fundamental problem. And I don't think the people in Washington, D.C. have any understanding, or I should say most of the people have a very low level of understanding of just how much they're playing with fire here.
We'll
And we
also
need,
tell you that most of them, both political parties, they don't care. So as long as they can either get rich quickly, so get their 5 million or 10 million on insider stock trades, or get their corporate clients or their friend who's a lobbyist an unbid government contract, they'll be taken care of later. So they're either in it to get rich quickly or to get richer. So that's kind of the attitude there, that like, well, that national debt, that problem there that's going to happen later, that's not their problem.
I think that's right. I mean, it's a very short-term oriented philosophy, and it's a very much a kick the can philosophy. And And to be fair, it's kind of worked for them because they do have all the levers. And when a problem arises, they just change the rules and fix it. But I would submit to you that the problems are getting larger and larger. The math is getting more and more compelling against them, or more and more, adverse to them. And that eventually, this next one could be big enough that they're not going to be able to fix it, or that the price of fixing it is going to be printing $20 trillion. And then everybody who's thinking that inflation is going down, and that's to me, one of the most amazing statistics, Jason. I'll tell you this: we have a Bloomberg terminal. They're very expensive, but it's worth it. And you can get something on that called the 5x5 inflation swap. And what that it's just a derivative contract that people trade. And right now, though, the world, the market, the people who are trading those, they believe that in you get a number, which is, what do people believe inflation will be 5 years from now for the next five years? So what's the average inflation rate between 5 and 10 years out? And that swap right now is trading today at 2.7%. And that just stuns me. That says that everybody is still looking in the rearview mirror and saying, okay, we're very much in the same kind of situation that we were in, between 1980 and 2020, where we're in a deflationary environment. Inflation is not a problem.
That's not what so that goes totally, those are Wall Street traders, right? Are those like bond fund managers and hedge fund and family offices,
correct,
people that are doing that totally goes against the real economy. You look at the surveys for business owners, and business owners are like, oh my God, how do I deal with higher interest rates, higher debt, higher input costs, wage price spiral, higher energy costs, higher insurance costs? All these costs for a lot of business owners out there, they're still going up. They're still dealing with stagflation and shrinkflation.
Right. Yeah. I mean, that's right. I mean, it's a real problem.
Well, yeah, so it doesn't make any sense. But then the other thing here that doesn't make any sense is the supply demand mismatch for US Treasuries. So you have the DC with the spending. There's too much supply of Treasuries now. And yeah, retail investors are getting around 5% for a 1 month Treasury bill or something.
Yeah,
which is
the curve. Yeah, the entire Treasury curve. If you're anything between a month and 5 years, well, no, I guess at the 3-year mark you're at 4.8, but 1 month to 2 years they're all start with a 5.39, 5.48, 5.5, 5.4. The 2 year is at 5.04, 3 years at 4.8. So
retail investors are buying those up like crazy, and yeah, they're getting a good nominal yield. It's good for people to park some cash there, maybe short term, look for other opportunities. But the main problem I see is that the foreigners, so the large governments, so China, Germany, Japan, those were subsidizing our budget deficits. They were recycling trade surpluses there with vendor financing. They're not buying it. No one outside the G7 is buying US Treasuries. It seems that they saw what happened with Russia, 18 months ago, with the
correct.
300 billion confiscation. They just decided really since then, a couple months after that they don't want to be buying a lot of US Treasuries.
Right. And it actually started a bit before that. On balance, the foreign holdings of Treasuries have gone down consistently since 2014. And then more recently, they've actually become more active sellers of Treasuries. And as we alluded to earlier, in Japan's case, Japan has got a real problem. Their currency is really starting to slip. If you go look at a curve of the US dollar Japanese yen exchange rate, it's gone the wrong way for Japan. And they need to service US dollar debt. They need to buy oil, sometimes priced in US dollars. Not all the oil sellers will accept yen. And so Japan has a very large balance of US Treasury debt, and they can sell it in order to buy the yen and defend their currency. And they will. So my view is that, this goes back to the heart of the matter, which is the US fiscal situation. The US federal government is acting in such an irresponsible manner that, basically people are going to come to lose confidence in US bonds and then by extension, US dollars.
And all fiat currencies. Look at the gold prices outside of US dollars. Look at the gold prices.
Well, that's right.
Japanese
it's
yen.
at all-time highs in every currency except the dollar. Yeah. And in the dollar's case, it's very close. I mean, we're at 1980 something right now. And the all-time high was 2070 for a day, and then 2050 before that. We bumped up against this slightly over 2000 level a couple of times. We actually were there, close to there back in 2011. We were at 1900. But once it takes out that level, there's kind of a line drawn across the chart just at 2000, slightly above. Once it takes out that level with authority, I think gold's going to squirt up to $3,000 in a heartbeat. All the algo traders would jump on it. And, to me, what's going on here is we're seeing a very slow realization of what I've described as occurring in the fiscal situation with the US federal government. And you're starting to see it in the Wall Street Journal. More people are talking about it. More mainstream people are talking about it. And none of them are saying this is going to be a huge problem yet, but they're alluding to there's an issue here. And I mean, a year or two ago, they didn't even admit there was an issue. So that's a start. And what's eventually going to happen is it's going to become more than an issue. It's going to be, there's a serious issue here. And if you hold these bonds, you're going to continue losing money. And then at some point, the dam will break and there's going to be a waterfall out of these things. And interest rates will go higher and we'll just be in a full-fledged crisis. And what that'll force the Fed to do is yield curve control and we know this because back in the 45 to 55 area, they put in yield curve control to deal with the heavy debt level that they had post-World War II. And of course, what happened in that time frame is that U.S. bondholders just got crushed. And I think that's what's going to happen here. I mean, in my view right now, there's no security in the world that's worse than a long-term U.S. bond. I mean, if you're buying a 20-year, a 30-year, a 10-year U.S. bond, and you're getting paid 4 or 5% interest for that, 4.8 in case of the 10-year right now.
And we've already had a bond bear market for 3 years. I think it's one of the longest ones in history. But you're saying that the bond bear market on longer duration treasuries can go for a lot longer than that, for years longer?
I am. I think it's gonna go to the point where the treasuries are worthless, but that's not tomorrow. That takes several years. But I think the bear market in bonds is going to continue. I mean, a good way to look at this, Jason, in my opinion, is to look at the 70s and look at how much money people lost in bonds in the 70s. By the end of the 70s, bonds were considered a certificate of confiscation. That's what Henry Kaufman, the bond guru back then, called them. I mean, you just got crushed. I mean, and the reason I say all this is because we've shifted from a deflationary world to an inflationary world. And I think most investors have missed that transition. And they still believe, this is back to the swap thing I was talking about, they still believe we're going to, this is kind of bad for stocks and bad for bonds. But you know what? Just like every time in the past, they're going to put it all back together and we'll be back to the good old times. And stocks will go higher and bonds will rally as the economy slows down and so on and so forth. And to me, that's the consensus thought pattern that's taking place. But what I don't think people have realized is that there was a fundamental shift that occurred. I mean, as you know, we were at the point where, we had negative yields on foreign bonds. I mean, come on. What's that all about? You know what I mean?
Well, there was like 18 trillion or something like that of negative yielding. And then the European Central Bank for 5 years went negative interest rate policy, which was just shocking. Now it's finally come back to haunt them because they allowed all that government debt to be spent, issued at artificially cheap rates. They allowed many thousands of zombie companies to exist. And then once interest rates went up, those companies are going to be fully dead.
Exactly. That's exactly right. So, look, I mean, it's sad. It's sad to see what's happening to our country. It's sad to see the jokers that are mismanaging all this. The whole thing is it's terribly sad. But
well, what I see a lot of people saying is that interest rates are not that high, but they don't understand the context. We were discussing this before we started recording. The total debt levels at the government level, corporate debt, all consumer debt, all levels of society, they've never been this high before in history. We've never had 300 trillion over 300 trillion of total global debt. In 2008, I think it was 200 trillion. So it's up a lot in 15 years. Corporate debt in the United States, I think, has doubled since the last financial crisis, 2008. And consumer debt's high, student loan debt, all these things are way higher. So when the interest rates go to a quote unquote normal level, 4%, 5%, mortgages are higher, the debt levels of society are way higher. So it's not an accurate comparison to say interest rates are only up a little bit, it's on par with past history. Well, the debt levels of society were never at these levels in the past when interest rates were that high.
Well, that's right. And what I think, a lot of people have forgotten is just how large the distortion is as a result of interest rates being at zero. I mean, when they, recall that coming out of the 2008 crisis, we put interest rates at zero. They stayed there until 2015. I mean, that's 6 years of free money. And interest rates...
It juiced the crap out of the stock market.
Exactly. And that's why the stock market went straight up, borrow for free and invest in stocks. And so we didn't have an inflationary bubble. We had an asset-driven bubble. And then from 2015 to 2022, there was more of that, but there were a few periods where they kind of tried to tighten up. And of course, that led to the 2019, the repo blowout and so on and so forth. But, and then of course, when COVID hit, they not only had ZERP interest rates, but they also decided to grow the money supply by 40%. So, look, I mean, recall that in 2018, 19, Fed people were saying, well, we've got this problem. We're not meeting our inflation target. Well, okay. So they put their feet on the gas trying to meet then they met the target. They not only met the target, they overshot it. We went to 9% inflation. So
that's CPI. I mean, I interviewed John Williams a couple of months ago. He had the inflation rate up to just under 18% at one point in 2022.
Doesn't surprise me. I mean, the Shadow Stats did a great job of that. I mean, we know for a fact, and there were some of the stats showed that. I mean, rents were going up 18% year on year. Houses were going up 20% year on year. I mean, yeah, there was a lot of nutty stuff. So the free money really, really distorted things and still has distorted things. And so anybody looking at it today and saying, the 5% interest rate's not that high, true, but consider all the malinvestments and all the things that got puffed up in what you and I have referred to as quote unquote the everything bubble, because they at the currency level, they just went crazy. They gave away free money to try and get things going again. And so,
well, also let me add some more examples here. I see people saying that 8% mortgage is not that high, and then they talk about the 70s. It's a totally different time period now. I mean, a lot of people at the current mortgage rates, they can't even get approved for a mortgage.
Well, there's that. Yeah, and people are trapped in their houses. I mean, people who have a 3% mortgage certainly can't afford to buy a bigger house. And I think you pointed out pre-show that housing sales in the DC area are down 70%. I mean, it's similar.
And this is recession proof. This is considered quote unquote recession proof.
Right. I mean, it's similar where I am in Boston. I mean, I know realtors are hurting because anyone who has a 3% mortgage, they're not selling that house to buy a different house or a bigger house because their cost is going to go up substantially. I mean, I think the 30-year mortgage rate is now hovering around 8%. Right.
Yeah. So we have the CPI that's saying that and then GDP saying inflation's lower. The CPI is probably going to come in lower with the base effects. The reality for business owners and consumers is something entirely different. I mean, look at the gold miners. I want to transition to gold miners now, Lawrence. Sure. Bitcoin for the last part of the interview. The cost for the gold miners, I put out an article on this going through all the costs since the last 3 years. It's just insane how much the costs are for the gold miners in the last 3.5 years. Newmont went from around $1,000 an ounce cost in 2020. They're almost $1,500 an ounce in Q2 of this year.
It's actually, it's funny you should mention this because I saw a chart on this too. You maybe saw the same one on Twitter. I mean, all the ASICs on all these companies, they used to be spending between $700 and $1,000 to pull an ounce out of the ground. And now if you're at that level, you're a real outlier. I mean, the range is kind of $1,200 to $1,800 or $1,700, with maybe the average being around $1,200 or $1,300. Which when you're selling the gold at $1,800 or $1,900, it's a little higher right now. You make a profit, but you still got to replace what you sold, and you've got capex and other ongoing kind of maintenance. So it's not it's not as good a business as you think, and I think that really drives. I mean, I think what you're alluding to here is, the gold's hung in there in spite of the fact that we've had an incredibly tight Fed and that M3 is actually shrinking, not growing, and we've got all this monetary tightness, so to speak. Gold has kind of hung in there. We're within 5% of an all-time high, but the gold miners have not. They've gotten hammered. The gold miners are trading like gold's going to 16 or 1700, which I don't think it is. But again, let me elaborate on that. One might say, okay, fine. Well, why? What is the gold miners have gotten hammered? Tell me why. What's that suggesting? And I'll tell you, if you go to Bloomberg and you do you look at their surveys of what people think gold is going to be, the average for gold 5 years out is kind of $1,800. So, if you believe gold will be $1,800 in 5 years, and you look at what's going on with the cost to mine the gold, well, guess what? Most miners won't be profitable in 5 years, so the stock should be in the toilet. And so,
let's add some more here. So that's the gold miners, and people are saying that, the costs are not going to rise. The gold miners should be in the toilet. But when you look at supply demand for actual physical gold, central banks, the non-G7 ones, are buying tons of tonnage, and there's really strong physical gold demand outside the United States. So in Japan, in mainland China, India, a lot of these other Turkey, a lot of these other countries, there's very, very strong demand for physical gold.
Absolutely. And I'm sure you've noticed, and I have too, on the Shanghai exchange, gold is selling at $100 per ounce premium. That's like a 4% premium to the world price on gold. And that's because people are probably settling other trades over there, and they want to, they don't want to hold dollars. They want to hold something they know is sound. So they take their, they've traded in yuan and in China for oil or whatever, and then they take it and they immediately convert it into gold. There's not enough gold there to supply them, and so it sells at a premium to gold somewhere else. So yes, I mean, the market for gold is extremely tight. To finish my thought on the miners, though, what's going to happen, in my view, they're suppressed because people, the world is saying they don't think gold prices are going to go up. Gold is going to take out this 2,100. It's going to squirt to 2,500 to 3,000. And then suddenly everyone's going to go, oh, I get the joke. Gold's not going to 1,700. I mean, even to this day, I still get presentations out of Toronto from mining companies where they've modeled their returns on 1,650 gold. They're looking at the last 4-year average, and they're trying to be conservative. Well, and the returns aren't that impressive. But, if suddenly the world comes to see that gold is going to 2,500 and they start modeling the returns on that, guess what? The IRRs get really impressive. And my view is that given the monetary constellation that we have, there's no way that gold doesn't go to those prices. It's just a matter of when. And I think it happens within 6 months, perhaps even sooner. But, the setup right now, as I see it, looking at the technicals, looking at sentiment, looking at everything. And, I read Michael Oliver, I read Fred Hickey, I look at, the bullish percentage gold miners. I mean, there are all kinds of tools I use. And I'm extremely excited about what I think is going to happen in the next 3 to 6 months. I think gold is going to break through that $2,100. And then I think the stocks are going to just ignite, because they've really been suppressed. And that $1,700 consensus future price of gold is, everyone's going to reevaluate that and go, oh shit, we were wrong. Gold's going to be $2,500. These miners are going to throw off a ton of cash. They are way cheap. And so I've got a portfolio of companies that I think will double or triple in value in the next couple of years.
Yeah, sentiment's super negative. It's almost as if the gold price is at 1,500 or below, because Correct. You look at where interest rates are. So a lot of investors are saying, why should I invest in a risky producing gold miner or a junior miner when I can earn in a quote unquote risk-free 5% in treasuries or something else that's relatively safer? You have nominal metals prices that are just below 2,000 now at 1,984, but the Denver Gold Forum back in September was empty. There was no one there.
I was there. I was saying to somebody earlier, felt like being at a funeral.
Well, that would be a contrarian indicator then, wouldn't it, that the bottom is soon?
Yeah, I mean, it's just, I mean, there were people there. Who was there? And the smart people were there. The people from the development part of the big mining companies. So the big mining companies, some of them have, good balance sheets, lots of cash, no debt, the ability to borrow money. And what they were there for is they were there to look at the little companies, because the little companies don't have the ability to raise money, don't have the ability to borrow, and they're all just dying. And that's the other thing. If you're not a cash flow positive gold miner right now, it's a very hostile environment in which to raise money. And so your stock has gotten very beaten up because people are afraid of future dilution. And so what we saw was, what I saw was a lot of very large gold mining companies, sniffing around because they can buy, ounces in the ground that there were so many companies there that had spent between $50 and $100 million to develop a resource and a plan and everything else. And they were selling it 25% of what they'd invested. And so if you're a large miner, if you're Newmont or Barrick or one of the other large miners, you can say, well, should I go invest this de novo and try and build a mine? Or should I just buy this company that spent $70 million on this project and it's selling for $25 million? And so in my view,
or a joint, you don't have to buy the whole thing. You could do a joint venture
and we've seen that. I mean, Goldfields with the Cisco. Yeah. I mean, so in my view, when we get through this next layer on the gold price, which I believe is coming, I think you're going to just see a slew of companies getting bought.
Yeah, I'm looking at the companies now that are kind of contrarian and looking at acquisition. So you mentioned Goldfields and Osisko. That's the Windfall project that's going to go into construction soon. Greenstone with Equinox Gold, that finally looks like construction's almost done, and they're going to have first gold pour in the next couple quarters for a potential turnaround play. I know the shares are down like 80 or 90%. Insane.
By the way, I love that company. I love Equinox, and I kind of like Osisko. I'm a little frustrated that they did a deal. They didn't use debt, and did the deal with Goldfields because it dilutes the equity return. But but I like that. That's a great deposit. It's a world-class deposit. But yeah, I can
Are
list.
you're referring to the Greenstone mine, right?
Well, no, I was, well, yes,
Oh, wait, sorry, your
Equinox, I was referring
Windfall.
to
Yeah, sorry,
Greenstone.
sorry,
Yeah, no,
mixing.
I was referring to Windfall with the Osisko mining.
Yeah,
But
okay. Yeah, that's the
I
one
mean,
in Quebec, and then the Equinox Gold is the Greenstone mine in Ontario.
correct. So yeah, I mean, I've got a portfolio full of companies that are trading at between 2 and 4 times existing price cash flow, and many of which have very rich development projects. So, to me, I mean, I feel like there are 5 and 10 baggers laying around all over the place. Now, to activate that, we do need a higher gold price. But as I think and I'm sure some of your listeners know, when this stuff turns, it turns fast. I mean, in 2016, 2015 was the last period that felt like this we're in to me. I mean, 2015 gold stocks were left for dead. Gold was left for dead. The sentiment was awful, just dreadful. And then it changed. They did the Shanghai Accord, and it became very clear they were going to weaken the dollar to try and get some commodity inflation because they realized all the shale oil guys were going to fail if they didn't. And then what you saw was in 2016, the gold miners very quickly went up 150% in less than a year. And I think we'll see something similar here. And people say, well, I'll just wait till it happens and then I'll buy in. I'm like, okay, fine, you can do that, but you're going to miss the first 30%. Because if you go back and you check that time period in 2016, once they start to move, they move fast and they move hard. So, that's why I haven't sold my positions. In fact, I'm accumulating. I find as I find things get cheap, I just continue to accumulate them.
Well, to add to your points there, in terms of supply demand fundamentals for physical gold, I see growing demand outside the United States in the countries we mentioned. I mean, gold's at or near an all-time high in many different currencies: Japanese yen, Chinese yuan, Australian dollar, a lot of other countries. So demand for gold is strong there, and then non-G7 central banks. And then I see almost no incentive with interest rates at these levels, cost of capital, to bring on new supply for a lot of gold miners, unless you have an absolutely outstanding project like Windfall in Quebec for Osisko mining and Goldfields, or the Greenstone mine in Ontario, which is almost done. I think the costs are going to be around $900 an ounce for one of the top producing gold mines in Canada if they hit the production guidance numbers.
That's correct. And it's a very short list. I mean, another one I like is Marathon up in Nova Scotia. Only the very best projects have gotten financed. And there are a lot of projects that make sense, but the capital's not there. I mean, there are plenty of projects. I mean, I'm looking at one right now that's got a 70% IRR. I mean, that's damn good. That's, it will pay back its capex in a year and a half. That's very short. And yet, it's probably not financeable yet.
Is that a junior? So you think they'll get bought?
Yeah, it's a junior. Yeah. I'll mention it actually. Here's a freebie. Heliostar. I love this company. Absolutely love it.
Is it in a geopolitically safe country?
Oh yeah. It's in Mexico. I mean, arguably, Mexico's not perfect, and it's in Guerrero in Mexico, which is arguably not perfect as well. But yeah, I love it, and I think they're fine geopolitically.
So I want to transition to Bitcoin for the last couple of minutes. Sure. Where do you think that Bitcoin demand is coming from lately? Because we've had a rally in Bitcoin.
Yeah, so I think Bitcoin and gold trade similarly. I think gold tends to lead and sees around the corner often a little before Bitcoin because it's more widely distributed and it's got more of a worldwide market. I mean, consider the Bitcoin market is still a smaller market. I mean, there's $500 billion in Bitcoin. There's $10 trillion or $12 trillion worth of gold out there. But I think Bitcoin and gold are both seeing the fiscal problems the U.S. has, and they recognize it's becoming clearer and clearer that their only solution is to print. And so I think Bitcoin and gold are starting to smell that, and that's why they've both been strong relative to a situation where you've had rising real interest rates. In terms of, I think you asked, where do I think Bitcoin can go?
Well, demand. Where do you think is the demand coming from, say, Turkey, Venezuela, mainland China, where there's
maybe I mean I think it's broad based all over the place. I mean, I see family offices starting to do it. I mean, I think there's a certain part of, and who knows, maybe some of these people who think they're going to get approved with the ETFs are going to do it. But to me, it's a very, very interesting situation because, as you know, there's a big part of the world that can't buy Bitcoin. Any RIA money really doesn't have a way to buy,
Bitcoin with
Bitcoin.
customer funds. So I know
Yeah,
large, I know the institute, I've seen them at the DC Blockchain Summit, vice presidents from Microsoft, bank presidents and vice presidents. So those guys buy Bitcoin with their own money. They just can't do it with client money.
Exactly. You can't do it with client money. You can't do it with company money. I mean, nobody's going to buy a Trezor and cold store. I mean, so there's $10 trillion at least of RIA money in the United States, which, now realizes that Bitcoin's a good performing sound money asset. Some piece of that would like to come over and buy Bitcoin, but they can't because they can't custody it. They're just not, the laws don't allow them to do that. But if and when there's a Bitcoin ETF, and I believe there will be one because 7 people have applied, and one of them is Blackstone or BlackRock, and they have all kinds of power in the government, et cetera. So a Bitcoin ETF is, Gensler's going to get run over, and a Bitcoin ETF is going to get approved. And when that happens, all of that money that's sitting there that wants to buy it now but can't is going to come in, and they're going to be competing for it. And by the way, the market cap of Bitcoin is 500, maybe approaching $600 billion, but not all of it's for sale. If you do the on-chain analytics, what you find is that 75% of it hasn't moved in years. So that's what I call deep storage Bitcoin, hodlers who think it's going much, much higher, and they're not going to sell it for 40,000 or 50,000. They might sell it at $1 million, but they might sell some of it at 100,000. But to me, Bitcoin at 100,000 in the next year, that's a no-brainer. It's a very high probability event. I mean, worst case maybe 50.
So you don't think then that the Bitcoin ETF, then people, the Wall Street banks and the CME group will start to put options on futures and more futures contracts, and that will allow them for more paper price manipulation, similar to gold and silver?
You brought up a fabulous point, and I'm right there with you, brother. I mean, I do. I mean, and it's a mixed blessing. Okay. I think it's entirely possible, because that's the way Wall Street operates, that there will become more and more paper Bitcoin, just as there's paper gold, which can be used to suppress the price. And certainly because I just don't put anything past BlackRock, and I don't trust those people as far as I could throw them. Having said that, it's going to be harder for them. They had many, many years and lots of different buckets and piles in which they could do it with gold. And, as we all know, the paper gold market is hundreds of times larger than the physical gold market in terms of the gold that really moves and settles. And in the case of Bitcoin, it's going to be slightly different. One, currently Glassnode is saying Bitcoin derivatives or Bitcoin futures are somewhere in the neighborhood of $6 billion, that are known, and probably as much as that's not known. But if you look at the context of the size and how much trades every day, I mean, that's not 100 times what trades every day. We trade $20 billion of Bitcoin every day. So it's not, I don't think the futures are wagging the spot price dog right now. The tail's wagging the dog now, the way it does in gold. The other thing I would say about the futures, I think is important to understand, is, Bitcoin is an asset that has gone up 5x in 18 months, right? It went from, $8,000 to 60 grand or so, it's gone up more. It's gone up 10x in a very short period of time. If you are short it and you're on the wrong side of that, you get your face ripped off. Gold has never done that. Gold has run 20 or 30%, but the manipulators of gold, and they've done it through accounts in the Cayman Islands, and they do it because I think the Fed and the BIS back them with an off balance sheet printing press. They know that it'll also sooner or later come back down, and they can work their way out of their position. I mean, it's a different animal to try to manipulate an asset that can do a 5-bagger quickly.
Well, you also have the halvings too. So that prevents probably as much paper price manipulation, because if you're short a ton of Bitcoin with the futures contracts and the Bitcoin halving is coming up, I mean, we know this from the past Bitcoin cycles that are like 3 to 5 years, I would say, give or take, since Bitcoin was created, that every time there's a halving that's coming up, even if Bitcoin's like in a correction or crash mode, it starts to bottom and then reverse fairly shortly after the halving. And
That's
I think the next one's what projected for April 2024?
It's coming up in April of next year. That's correct. And also there are a lot of guys who do very good on-chain analytics. So I'm sure BlackRock won't report the ETFs won't report what addresses they're using, but there are people who are pretty good at watching all these addresses. And so we'll be able to see, if dollars in match new addresses with coins being purchased. And so they'll be, at least there's some semblance of auditability here. It's not perfect, but it's not zero. I mean, with respect to gold, a banker or anybody could lie and say we got the gold, and they don't, and it's a lie, and you can't call them on it. You can see where all the Bitcoin are. You can look at it on the chain. So it's better. I mean, it's much better. It's less manipulatable than gold, in my opinion. Is it? I mean, some Bitcoiners say, "Oh, well, it's totally unmanipulatable." I think that's naive. I think they're, and I'm sure, when Bitcoin did what it did, I'm sure alarm bells were going off in every central bank in the world. It was like, oh shit, look at this. This is a real problem,
Well, sometimes the banks don't even know that they have fake gold. I mean, the banks have done a bunch of shenanigans, but sometimes the bankers are even fooled by fake Chinese gold bars that have like
Well,
gold
that's
plating
right.
and lead
That's
or
right.
tungsten.
Yeah, no, that's right. Look, and that's why, look, I'm a gold guy. I've always been a gold guy. I'll continue to be a gold guy. Personally, I'm about half gold, half Bitcoin. What I like about gold is it's not as volatile as Bitcoin. What I like about Bitcoin is it's going to kick gold's ass. I mean, it is a much better solution than gold.
Well,
We
also
live,
like if you go back and look up like it's hindsight's 2020, but I mean out of like over 250 gold stocks the last 15 years, I mean I think only about 5 of them are up enormously since 2009, and almost all of them are the royalty companies. So the royalty companies like the Franco-Nevadas, the Wheaton Precious
right.
Metals, Royal Gold, those guys have minted money along the way, and then when there was a bear market, they just did more deals, and so they
Yeah, no,
diversified, they added cash flow or near-term cash flow, and then over like a couple of years after those deals were done, they grew.
that's absolutely right. That's absolutely right. And you know, the gold mining business is a very tough business. It really is. I mean, just like the Bitcoin mining business is a very tough business. Yeah.
Well, the royalty business compared to regular mining, I mean, the royalty business with the profit margins, the free cash flow, you don't have to worry about the capex issues. You can diversify faster, so it just makes more sense.
Yeah, no, that's right. It's a very good business model, and it's probably the safest way to play the gold mining stocks. I don't do much of it in my fund because they're fully priced, and there's not as much operating leverage. Do you know what I mean?
Well, occasionally they go on sale. I mean, some of the small cap ones, 3 or 4 weeks ago, like the baby was thrown out with the bathwater. I think like the Australian dollar gold price, I was buying Vox royalty. So I think Vox has a lot of good upside there. They're a small cap one with some good geologists, and they have some good cash flow there. And I think a lot of their growth isn't priced in. Same thing with EMX.
Yeah, I get it. Yeah, no, it's true. EMX is a great company. I love the CEO. I love the company. That's a royalty company with a lot of upside, in my opinion.
Those are the small cap ones. I mean, those guys. I mean, Franco Nevada could buy them if they wanted to, though, tomorrow. So we'll see if they're standing alone as sole companies, because I think like there's going to be some acquisitions going forward too. We'll see if what Franco and the other larger players decide to do, or if I mean Franco, from what I've heard, what Rick Roll said is they're looking at like these large gold or silver byproduct deals on new copper mines, though, that they're not going to go buy a little small cap like EMX, that they want to do like a 500 million or $800 million or $1 billion deal on a copper miner and buy an enormous stream.
Yeah, I think that's right. I mean, look, there's some very smart people in business, and the guys at Franco are probably right at the top of that list.
They have as good a track record as anyone the last 30 or 40 years. So even when the gold price was in a bear market, they were still growing.
Yeah, no, they've done. You can't argue with their success. They know what they're doing. They really do.
The stock is just never cheap, though, for the most part. That's a problem.
Well, yeah, but if it's, I mean, a lot of stocks have never been cheap that have been really great stocks. You buy quality and you get what you pay for, right?
Yeah, it's relative valuation too. So, I mean, if the stock is down, 30 or 40% from a recent high, then that might be an opportunity to go buy it.
Correct. Correct.
Well, I really enjoyed our discussion today, Lawrence. I want to thank you so much for your time. Please tell my listeners how to follow you on Twitter and about Equity Management Associates or the Bitcoin Opportunity Fund.
Oh, thank you so much for letting me do a little advertising. Yeah, so I'm on Twitter and I make a lot of noise. I hate the central banks. I think they've ruined our world. So if you want to listen to some of that, you can go follow me on Twitter. It's just my name, Lawrence Lepard, at Lawrence Lepard. My website and I've alluded a couple times to a quarterly newsletter that we write, which is free. And it's just a macro description of the investment case that we've made here. And you can find that on my website. It's www.ema2, Edward Mark Alpha, the number 2.com. You can sign up for a free notification. So when the quarterly comes out, it'll just get sent to you. We never spam you. And then, the fund itself I manage is involved mostly in gold mining and silver mining. The minimum account size due to SEC rules is 200K. So, and we are open. Sometimes we're not open, but we are open right now. And then the Bitcoin Opportunity Fund is a fund that we also manage with a bunch of other guys. It's not just us, but my partner and I at EMA, plus a few other guys, James Lavish and the people at Swan. And that fund is focused on Bitcoin and strategies surrounding Bitcoin, investing in companies that are building out the Bitcoin infrastructure. We think there's a lot of upside in that as well. The minimum there's a bit smaller; it's 100,000, and that'll actually be wrapped up at some point. That'll close and won't be open until we come to the second version of that, which will be a few years from now. So if people are interested in that, they should reach out more quickly on that. But yeah, I mean, I just all I would say is in general to your listeners, please think through the issue of monetary debasement and, try and figure out a way that you have some piece of your assets, not zero, hopefully at least 10%, maybe perhaps a bit more. Of course, I have 100% in what I would consider to be quote unquote sound money alternatives that they can't print. Because I think if there's one thing in the world that I feel very highly confident of, it is that the government will continue to print. They have to. It's mathematically certainty, and they don't have the discipline to stop themselves from spending. And so with that in mind, if you take a multi-year time frame, and admittedly in any short-term time frame, you can get hurt. I mean, if you bought Bitcoin at 68 and it went to 15, you're probably feeling pretty shitty. But if you continue dollar cost averaging, you're now back in the green because you bought a bunch at 15 or 16 and it's now at 35. So if you take a dollar cost average multi-year time frame on these things, I think we're all going to find that they're going to be much more valuable in the future, and they're going to have preserved our wealth and our purchasing power, and perhaps even grown it a good bit. So that's my free advice, worth what you paid for it, but that's what I believe.
Yeah, I see global currency debasement. I see a global debt problem at government debt level. Just there's too much debt in society. Historically, what they deal with is inflate the debt away in nominal terms or pay back the debt in nominal terms, pay those unfunded liabilities in nominal terms. Because, I mean, if they start taking away all those things, the politicians are going to get voted out of office immediately. So it's easier to just stagflate, tax, lie as long as they can.
Right. That's always the least painful thing for them. And they'll say they're not inflating, and they'll say there's no inflation. They'll continue to lie to us. But, we'll go to the gasoline pump, and, I remember when I was a kid, gas was 25 cents a gallon, and sadly, that's kind of only going one way.
Well, yeah, you have supply and demand too. I mean, if the politicians are also going to put bad policies that are ESG, and then they're going to make it so the non-ESG energy can't get any investment or new supply, or shut down oil refineries, or add like all these gasoline taxes, yeah, they're going to restrict supply. So there's going to be opportunities for all the commodities that the politicians are destroying with bad policy. There's going to be a lack of supply there too.
I think that's right. I think we are in a decade of a commodity bull market and inflation that looks similar to the 70s, perhaps even worse than the 70s in terms of inflation. And if that's the case, it started in 2020. So we're really only 3 years into this trend. So we've got at least a decade, we've got some significant time to run. You're not too late. I mean, the prices are higher than they were at 2020. But, we're really in the first or second inning of this inflationary period, in my opinion.
Exactly. And there's very little gold, silver, and copper supply that's projected to come online, especially with interest rates, cost of capital at these levels. There's not going to be a lot of new supply. No,
that's exactly right. That's exactly right. Jason, I really enjoyed talking to you. I got to run too. But I anytime you want to do this again, I always enjoy talking to you. Your knowledge of what's going on in DC and everything else is fantastic, and I think you do a great job with your show.